In today's video, we will be talking about options trading. This will be a very simplified, basic approach just to understand what options trading is and what the different aspects of it are. So to begin, what is an option? An option is a financial instrument that is calculated using derivatives and are based on the value of the underlying security. So underlying security that we're talking about is basically most of the time a stock. An options contract allows the buyer to buy or sell the underlying asset. One option contract usually represents 100 shares of the underlying security. And option contracts can be bought and sold via retail brokers. So wherever you are usually doing your trading, wherever you can buy and sell shares. And not all stocks have options. The basics of option. The most basic form of options are calls and puts. All options have a premium fee, a set expiration, and a strike price. The premium fee is based on the strike price and the expiration date. And calls allows the holder to buy the underlying asset at a specific price within a specific time. And puts, on the other hand, allows the holder to sell the asset at a specific price within a specific time. Now, holders of option contracts have the right, but not the obligation, to buy or sell the underlying asset. Okay, so now let's see how option premium is determined. Premium is the price you pay to purchase an option, and the premium is determined by strike price and the expiration date. Since an option contract represents 100 shares, the premium is multiplied by 100 to determine the price you would pay to purchase that contract. And the risk, or basically the potential loss, of the contract is determined by the Greeks, but that's a little bit more complex and we'll go over it in a later video. Now let's look at an example, because this is a little bit complex in just words, but I think a visual example would be the best way to understand. So let's look at Apple, for example. And if Apple is trading between around 120 and 40 cents, so the bid and ask, you can see up there, bid and ask. So if we were to buy a call that is expiring in 3 days, okay, so you're looking at it today, whenever today is, and you have a call that is expiring in 3 days. Now, if you get a call with a strike price of 119, okay, Apple is trading at 120.40 cents. Cut this part out. Start again. So Apple is trading at 120.40 cents, and you have a strike price of, no, start again. So let's look at start again. Let's look at an example. Apple is trading at about 120 and 40 cents. So if you're looking to buy a call, and a call would mean that you are expecting Apple to go up. So it's at 120.40 cents. You're thinking Apple is going to go up in price. So the call that we're looking at expiring in 3 days, from whenever today is, it's expiring in 3 days. And usually calls and puts generally expire on Fridays, weeklies especially. Nope, stop here. 3, 2, 1. Now let's look at an example. Apple is trading at 120.40 cents. You can see the bid and ask pretty close, around 120.40 cents. Calls, if we're looking at calls expiring in 3 days. What am I doing? 3, 2, 1. Let's look at an example. Apple. It is currently trading between 120.40 cents and 120.38 cents. If we are looking that, oh my God, 3, 2, 1. Let's look at an example. Apple is trading between 120.40 cents and 120.38 cents. 3, 2, 1. Let's look at an example. Apple is trading just above 120. You can see the bid and ask over there. And if we were thinking Apple is going to go up, it's going to continue going up, then we can look at calls. That's what calls are for, when you believe the price will be increasing of the underlying stock. So here again, the underlying asset or the stock that we're looking at is Apple, and we're looking at calls that are expiring in 3 days. So a strike of 119 is trading between $2.17 and $2.19. A strike of 120 is trading between $1.54 and $1.56, and so on and so forth. So that's the premium of the contract if you were to buy a contract with the strike of 119. The price that you would pay would be times 100. So here I just took the ask price multiplied by 100. If you were buying, a lot of people would just go somewhere in between the bid and ask, and to sort of get the best price. But just for this example, we went straight to ask. We want to get filled right away. 119 strike call expiring in 3 days will cost you $219. Of course, that doesn't take into account any fee that you would pay to your broker. Different brokers have different fees on a purchasing option contracts. Now, if you look at calls expiring in 10 days, similar strike, we're looking at 119, 120, and 121 strike. So you'll see that the prices are a little bit different. For calls expiring in 10 days, the prices are a little bit higher, and that is because you are paying for time. Time is part of the premium. Time has a price that you pay. So the more time you buy, the more expensive it will be. So if we were looking at calls out a month, 2 months, they would be increasingly expensive. Now let's look at, again, same underlying stock, Apple, but now we're looking at puts. So puts would be purchased if you thought, I don't think Apple will go up from here. I think Apple will come down. So the stock price is going to decrease. So again, puts expiring in 3 days works the same way, where you would multiply by 100 to get the purchase price of each option contract. So again, if you look at puts expiring in 3 days versus puts expiring in 10 days, there's a price difference because you're paying for time. And how do you make money? So simply put, a trader would buy a call option when they expect the underlying asset to go up in price, and a put option when they expect the underlying to go down in price. Now, if the price of the underlying goes in the direction of their speculation, so if they expected for the price to go up, they've bought a call option and the price does go up, then their contract or their option contract will appreciate in price, and they can sell for a higher premium. They can sell at a higher price, which means they made a profit. Now, traders have a couple of options with their option contract. They have until expiration to act on them. So either they can close their contract, which means if they bought a call or they bought a put, they sell the call or put for a profit, or if their speculation was wrong, or for whatever reason, they sell for a loss. Now, this is all prior to expiration. There is also an option of exercising your contract, and in that case, if you have enough money to purchase the underlying, so if you have one contract, you have enough money to purchase 100 of the underlying shares, then you could choose to exercise. However, you'll see that a lot of, or mostly, people just close their contracts or they let it expire worthless. And that will happen when your speculation was wrong, the underlying went the opposite of your contract, and slowly as the option contract depreciates, it eventually becomes worthless. Some of the risks of buying options are that option contracts are a depreciating instrument. If the underlying asset goes the wrong way, then your option premium depreciates. And of course, as we get closer to the expiration, the option premium also depreciates. Now, the further away the strike price is from the underlying, the cheaper your premium will be. Now, the closer to the expiration your option contract is, the cheaper the premium will be. Therefore, an option contract with a strike that's far from the underlying and expiring soon will be the cheapest, because ultimately, the less likely that your option contract will be profitable, the cheaper it will be. This video was meant to be just sort of an introduction to the world of options trading. Trading options is a little bit more complex than simply buying calls or puts. However, this is the basis of all of the strategies that involve options. Thank you very much for watching.